Have you saved very well in your 401k or IRA? So maybe you've saved $2 million or more. If so, there is a coming tax bomb that you want to be ready for, and you can actually avoid it. And today on this episode, we're going to tell you exactly how to do that.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
So, Merce, I wanted to talk to you a little bit today on the podcast about a topic I think we're both running into, which is people that have been good savers. They've put a lot of money away in their 401ks. Now it's in a traditional IRA for a lot of people. Or, they're getting ready to retire. And sometimes we're seeing people, even in their early 60s, with $2 or $3 million saved in 401ks, IRAs, between maybe themselves or their family. And the problem that we run into is this idea of what we know is this looming thing that's going to happen for most people today. If you're 62, it's going to be 73. If you're a little bit younger, it could be even 75, which could make this problem even worse. And what the problem is that at 72, you're going to be required by the IRS to start taking a distribution called a required minimum distribution out of your IRA and 401k. And I'm going to, just kind of set this up here. And by the way, there's another topic that just bounces right into this, which is the Medicare IRMAA. And people are like, what does IRMAA even mean? We're going to talk about that a little bit. But I mean, the good news is we run into a lot of people, and we get to sit with a lot of people that have been good savers. They've been disciplined. They lived with this mentality that they were going to defer the taxes into the future, and then when they get into retirement, they're going to take the money out of the IRA at a lower tax rate. And for a lot of people that have been good savers, that's really not what they're going to run into. They're going to run into this scenario where they could be in a bigger problem. So could you just speak to maybe some of your conversations and your thought process around this idea of required minimum distributions, what it means, what it could look like, especially if you think about the concept of a person who's, say, let's just go 62 right now.
Right. Yeah. I mean, with the good saver, it's one of those things where it's one of those, you could kind of phrase it in this way of it's a good problem to have. It means that they've done a good job of saving, building up that retirement nest egg, but now there's a future issue that we've got. And, a lot of people say in meetings with me is they say, man, I wish I just knew about this sooner. Because all I was really told was to save into that 401k. And while I did that, I liked that a lot because I was getting some tax benefit by putting money into the 401k. It came off of my income. It helped me out year by year. But now I've got this problem that has snowballed over time. And because I've got this $2 million 401k, I'm worried about my taxation in the future. And everyone said, my tax rate's going to be lower in my retirement years, but I don't think it's going to be that. So for everyone listening, the required minimum distribution is kind of this rule that the IRS put in place that when you hit a certain age, we're going to force you to start taking money out of that tax-deferred bucket. For most people, it's going to be that 401k or that IRA. And the reason is you got that big tax benefit up front for putting money in. You didn't pay income on that money that you put into that bucket of money, and now it's grown and it's got the power of compounding growth over time. And so I kind of joke with people and I just say, the IRS usually knows what they're doing, and they know that the dollar amount is going to be much bigger if it has some time to grow. And then, of course, the government needs their tax revenue, so they're going to force that withdrawal at some point for most people, that age of 73. Now, there's a whole formula to it. We don't need to get into that too much, but rule of thumb is it's around 4% of the IRA balance. So take your example of the person that's 62. And they've got $2 million, and let's just say that their required minimum distribution age is 73. So that's about 10, 11 years from now. And in most cases with decent management, decent markets, we could expect that $2 million bucket to double in a 10-year window. And so now that $2 million has grown to about $4 million. So now an even bigger tax-deferred bucket, and now they're walking into the required minimum distribution phase. So we say 4% of $4 million, well, that's about $160,000. $160,000 that the IRS says it has to come out every single year, regardless whether you want it or not, whether you need it or not. You got to pull it out and pay the tax on it, and then you can do whatever you want with the rest of it. So for most people, that 160 is going to be, pretty close to what their highest earning years were, or, not all that far off. And so you kind of get into this phase of like, man, I'm going to be making more, if not, or the same, if not more in retirement. And so what do I need to be thinking about? The good news is, in this example, the person's 62. So there's 11 years of strategy we can be talking about and talking through. And so that's the big thing, I think, is, having the realization at first of, well, I've done a good job saving, but what am I missing in this plan, or my lack thereof of a plan? Because not only is it the required minimum distribution that's going to generate taxable income, that what I say, 160,000, but also you've got your Social Security that's going to be coming in by then. And then also maybe other income sources, and then maybe you have a brokerage account that is generating interest and dividends, and maybe some capital gains tax. So you can quickly see how it just starts to snowball on us if we don't stay on top of it. And it's not so. I think there's two things. One is we want to balance and optimize taxation as best as possible, but on the same token, we also want to live the retirement life that we want to live, and not really give up things just because we're scared of tax. And I think the only way to do that is through just proper tax planning year over year over year. And Radon, I think a big strategy that does come up in planning conversations to kind of tackle this behemoth of an issue of required minimum distributions is this concept of Roth conversions. I know it's a big one. It's got its technicalities to it, but we talk about it all the time. So in tax strategy meetings, what are you seeing as far as these Roth conversations?
Yeah, I always tell people not everybody should do a Roth conversion, but everybody should have an analysis done as to whether or not a Roth conversion makes sense or not. The beauty of it is that we actually have an in-house person that's what she does. She's a tax strategist. We talk about her a lot. If you were on the podcast, she's been on the podcast quite a bit. Her name is Taylor Wolverton, and she's our director of financial planning and tax strategy. And what I love about what Taylor does, because she loves this topic of Roth conversions, because she can see the impact of it. And in fact, I asked her, I said, could you share with me an example? And we talk about it a lot sometimes when we're doing our live presentations. But the idea is that if I can convert money today that was in a tax-deferred status and get it over into a tax-free status, well, that's going to be good for me. Because imagine if I'm 62 and I can convert money today and go back to your numbers around the double. So if, let's say I convert, let's just call it $100,000 today. Now in 10 years, my $100,000 should be $200,000. The difference is it doesn't have required minimum distributions, and it's all now tax-free. That money grew tax-free for 10 years. And so that is extremely powerful. And so one of the things that we do is we say, let's do a smoothing process. So instead of just letting that money defer from 62 to 73 and then have these big required minimum distributions, what if we took a portion, let's just say half of the money, and we converted half the money? Well, now my required minimum distribution, instead of 160,000, is 80,000. And now I've got this money that's over in my tax-free status. One of the examples that we use in our live presentations a lot is we talk about Frank and Lily. Frank and Lily, they wanted to fill up their 22% tax bracket. And so basically what that means is, if you know how our tax code works, is that I've got different brackets. And what a lot of times people think, if I go into the next bracket, so let's say I go into the 22% tax bracket, sometimes people think that the entire amount of money is going to be taxed at 22%, but it's not. It's if I go into the 22% tax bracket by $1, then that $1 is taxed at 22%, not everything else. So what they said was, I want to fill up the 22% tax bracket, which we did. That was around $66,000 a year, and we did that for 5 years. Here's the key to it, though. Taylor basically said, hey, by doing this to Frank and Lily, it's going to save you over $300,000 by the time you're age 90. That's huge. That's huge if a person does that. Now, the key is, if I wait until I'm in my 70s, I don't have the window of time. And so this is really kind of like what we call a tax time bomb, a
Right.
tax time bomb
Yeah.
that's going to come into play. And so we really talk a lot to our clients about saying, let's make sure we look at these conversions sooner than later. And does it make sense? And so the beauty of it is that every single year, no matter what, Taylor's going to do a Roth conversion analysis for every single one of our clients in these tax strategy meetings. But here's another little gotcha that I think we ought to talk about. We've done episodes on this as well. But is this thing that if we don't do it, it's another penalty that's going to come hit us, and it's dealing around Medicare, and it's called Medicare IRMAA surcharges. So can you just speak about that? Because I know you've talked a lot about that with clients and what that's a big surprise sometimes.
Yeah, I think it's one that kind of goes under the radar for a lot of people, and then it shows up usually at the wrong time, or it always ends up being a surprise when they get that letter in the mail from Social Security that says, hey, you've got this IRMAA surcharge tacked on to your Medicare premium. So what IRMAA is in a nutshell is, and I'm going to try to guess at the acronym. I know it's income related Medicare adjustment amount. The last A may be wrong, but it's a phrase that kind of helps recognize that you're going into some area. I would call it a penalty. It's not really a tax. It's more of a penalty.
I bet you nobody's going to ever name their child Irma ever again.
Right. And so basically, it's a penalty for generating too much income in retirement. That's kind of how I explain it to people. And really, how the point at which you need to start paying attention to this is when you're at the age of 63. Now, you may be thinking at 63, I'm not in Medicare, so why does that matter? Well, the way Medicare operates is they look back 2 years to determine if you are in a surcharge window or not. So when you're eligible for Medicare at 65, and at 65 they're going to look at your income at your age 63. So it's a 2-year look back. So when you're 67, they're looking at your 65 income. Why that matters is because if your income is over certain thresholds, and we can round it, we can say for married filing jointly, over 200,000. There's a specific number, and I'm not going to get specific on exactly what that is. It actually moves every year based off of inflation too. And so if you go above this, kind of like tax brackets, if you go above a certain dollar amount, you go into the next bracket. Well, if you go above this fictional $200,000 amount of income, then you are subject to surcharges on Medicare Parts B and Parts D. And that can amount to hundreds, if not additional thousands of dollars a year for a married couple if they're on Medicare. And so that really, people hate paying taxes, but I would say in my experience, what they dislike even more is having to be subject to IRMAA surcharges if they weren't aware of it or if we didn't purposefully go into it. So what does that mean? Well, so when we're thinking about our withdrawal plan and how we want to live and the money that we need every single month to live the way we want to live, you got Social Security coming in. That's usually a small portion of people's needs. And then it's the withdrawals that we're making. And if we're withdrawing so much that we go into this IRMAA threshold, well, that could be problematic for some in that their Parts B and Part D gets a little bit more expensive every single month. But when we think about this timeline, so go back to our example of the person that's 62 and they have required minimum distributions coming at 73. I think a really important thing to know and just think about is your RMDs are based off of the value of your IRA every single year once you're in the RMD phase. So if we can get the value of our IRAs down or our pre-tax buckets down, then the calculation goes down, the math goes down. And so the only way to do that, to get your IRA balances down, is either it's almost as simple as you spend it, you give it away, or you convert it to Roth, which is what you were just talking about. And so while that conversion to Roth seems really attractive, outside of the fact that you have to pay some tax to do that, we do have to now think about this other layer that's being added on, which is this IRMAA surcharge. And so I think what's amazing about Taylor and the tax team as far as these tax strategy meetings, we definitely take IRMAA into account and saying, hey, if we want to get X amount into the Roth bucket, so that $4 million or IRA balance, if we want to get portion of that, maybe $1 million into a Roth account over time, how much do we do every single year to not just pay attention to the tax brackets, but now introducing this IRMAA concept, we have to pay attention to the IRMAA brackets as well. And staying within those thresholds and kind of just chipping away at it every single year until we reach that age of 73 and the required minimum distributions flip on. I think there's plenty of reasons. We have some clients that say, no, I want to tackle this problem get ahead of it. And I'm okay if I go into IRMAA for a few years because I understand the long-term tax benefit of it, right? I want to convert, this is an aggressive stance, but I want to convert all of my IRA dollars, and I know for 3 or 4 or 5 years I'm going to pay hefty IRMAA surcharges, but this is money that I just want to get converted. I don't want to deal with RMDs. In fact, I don't even need this money. This is all for the kids and grandkids, right? That could be a tremendous reason to pay some additional upfront types of cost to get this money in a place where it can grow tax-free for a very long time and then inherit tax-free as well. So that's one example where it, IRMAA, while I paint it negatively, there's reasons to go into it, but the only way you figure that out and the only way you figure out Roth conversions and, your withdrawal strategy and what your tax is going to be year over year is you talk about it every single year. And we believe it needs to be done through a formal tax strategy, meaning because really every family is different. They're going to have different goals and wishes and legacy wishes and everything like that. So you gotta kind of do them individually. So I know I kind of went in circles there. Raiden, did I miss anything on the IRMAA piece that you want to add in there?
No, I think it was good. I think this really does, if we want to close it out, I mean, to me, it shows the power of having a written, holistic financial plan focused on the income plan part of that, which I always ask people if, when they come in and we ask about, so we talk about our 5 critical areas to a successful retirement, which we call our route to retirement. And when you look at that, the O in the route to retirement is optimize income, and then the T is tax planning. Both of those work very close hand in hand, and that's why you need to have an actual written plan. So what I would encourage, if you're listening to this and you're thinking, hey, does a Roth conversion make sense to me? I would encourage you to go to our website, which is pomwealth.net. Go to schedule a call, and we would be glad to hop on a phone call with you and kind of walk you through what that route to retirement looks like. A big piece of that is tax planning, tax strategy, and as well as having a plan in place, and that creates what we hope, which is peace of mind as you plan for and live throughout retirement. So thank you very much, Merce, for the nice discussion, and we'll talk to everyone again next.
If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.